This is one of the easiest but one of the most powerful ICT strategies with a high win rate. With 4 easy tips, go check the chart yourself and see how it performs. You can use the inverse fair value gap as a strategy or even as a complement to your current strategy. I'll go over these tips and different examples so you understand everything very clearly. If anyone needs one-on-one mentorship, check out the description. This is Mulham Trading and let's get into it. So let's start with a comparison between the 2022 mentorship model and the inverse fair value gap model that we're going to cover today. And why with the 2022 mentorship model? Because almost everyone is familiar with it already. So what do we look for in the 2022 mentorship model? Basically, we start with a liquidity sweep. And after the liquidity sweep, basically price sweep the liquidity, goes back into the range. I want to see a displacement with a change of character. So price displacing above, in this case, above the last high. And then we expect price to retraces back into a fair value gap. And we enter from a fair value gap. Comparing this with the inverse fair value gap, what do you look here? So we start with the same thing, a liquidity sweep, and then we do not look for a market structure shift or a change of character. And that's why, a lot of people miss trades just because of this. And we're going to cover this later. So we do not look for change of character or market structure shift. We just look for a single fair value gap in this manipulation leg or this liquidity sweep leg. When it's unrespected or violated, we wait for a retracement into the inverse fair value gap in this case, and then we go up. So a lot of differences here. You can actually target this high right here, which a lot of people are waiting for, to go above as a change of character and then buy again. However, you can enter here and actually target this high right here, which a lot of people waiting just for a change of character. They're not really entering a trade. However, you're entering a trade here and taking profits at this level. Now, how is it different? So, how is the inverse fair value gap different from the 2022 mentorship model? And is it better? Is it worse? So, in the inverse fair value gap strategy, there is no need for market structure shift or change of character. As we discussed, the market structure shift is actually violating the fair value gap itself. Because of this, you're gonna miss much less trades just because of the market structure shift or the change of character. A lot of people, even they come to me in Discord, they say, okay, Mulham, we are missing a lot of trades just because we are waiting for change of character or market structure shift. And we need something, more risky just to catch those trades. And this is one of the things that you could do. This is one of the solution, and it has a very high win rate. So you can try it yourself. It's not as subjective as market structure shift or change of character. Now, a lot of time, and you for sure experience this. Sometimes you're waiting for a swing high to be broken or for price to go above it for a change of character. However, other people are waiting for other swing highs to be taken. And when you ask them, oh, is this a valid change of character? They say, no, 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 you got to go all the way above. And then you ask other people, they say, no, 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 it's already happening. There's already a change of character. So it's very subjective. However, in this strategy, and what I'm going to teach today, it's so mechanical, it's not subjective. Why? Because we're dealing with fair value gaps. And we know that fair value gaps are three kind of pattern. You cannot say, oh, this is a fair value gap and this is not. It's either a fair value gap or it's either not, so we cannot be subjective in this case right here. Also, it indicates an early market structure shift or change of character. Violating that fair value gap, it tells you that price is going up now or going down now. So you would be, it's going to be acting as a change of character actually. If you're looking to secure up to $4 million in trading capital, look no further. Bespoke is one of the best firms in the industry now. Trade at your own pace with no time limit, very low spreads and slippage. Request a payout in 14 days and get it in less than 24 hours. Balance-based daily drawdown and much more other features. For a special 10% discount on all accounts, use code MULHAM at checkout and find all links in the description. Let's continue. Now, what are the tips for this strategy today? First of all, we're going to look for a liquidity sweep. So first of all, liquidity level, we wait for a liquidity sweep in London or New York kill zone. Now, Absolutely, you can trade anytime you want. However, if you want a higher probability setup, then it gotta be on London or New York kill zone. We're gonna wait for price to come back into the range, and we prefer to see displacement into the range. So a liquidity sweep, price back into the range, and then we look for a single fair value gap in the manipulation leg to be violated, to be disrespected, and it should be a single fair value gap. Now I can create other videos about how to deal with multiple fair value gaps, but in this case and in this video, we are focusing on a single fair value gap on the manipulation leg to be violated. And how is it violated? It needs to have a candle closure above the fair value gap. And we're going to discuss all of this in the example, so no worries about this. And then we enter from the retracement into the inverse fair value gap. Now again, going over the steps, but in the diagram instead of just text. So first of all, we look for the liquidity sweep, and we can see, for example, we have this low, which was taken by this low, and we can see price did not displace this below, and it also did not stay below this level also. Immediately it goes back into the range. So price back into the range, this is the second step. And in this manipulation leg or the liquidity sweep leg, we only see one fair value gap. So we have a single fair value gap here, and this single fair value gap is violated, which means there is a candle that closed above this fair value gap. In this case, we are really looking for price to get back again into the inverse fair value gap, or basically retraces back into the inverse fair value gap, and then we enter on the retracement with different types of entries. We're going to cover the different types of entering here, and then we target the liquidity or the drawn liquidity. Now, what are some of the entries that we can rely on when it comes to the inverse fair value gap? Now, we have a lot of different entries, and they're not limited to those 4 entries. However, those are the ones that we're going to cover today, and I'm going to give one example for each entry right here. So we can basically enter at the beginning of the fair value gap. We can also enter at the 50% of the fair value gap. Now, 50% of the fair value gap is going to give us a better reward to risk, but beginning of a fair value gap, we're going to enter more trade. So sometime using the 50% of the fair value gap, we're going to miss some trades, but it's going to give us a better reward to risk. We can also enter in a fair value gap inside of an inverse fair value gap, and it's going to be actually a BPR, a balanced price range. And this is a very high win rate. If you just rely on this, you're going to get a very high win rate using this fair value gap inside of an inverse fair value gap. You can also apply a lower time frame entry. So if you are getting that inverse fair value gap in a higher time frame, you can rely on a lower time frame to get an entry inside of that inverse fair value gap. Now let's cover some examples, and as I said, I'm only going over 4 examples. And why? Because I'm planning to make a full video backtesting this strategy for like a month or 2, whatever. So a lot of more examples are coming into the next video when I do the backtesting. But for now, we're only going over examples just to understand how we can apply this strategy. Now going over this example right here, and we have an entry of a beginning of a fair value gap. So what do we see in this scenario? Okay, so price was going low, and then we had a sweep right here. Price went up, but there was no fair value gap, so there was no entry right here. We had no entry at all. And then what happened after that? We had this liquidity level here, which was taken with a fair value gap. We had a small fair value gap right here, and then price went up back into the range. So we see how this is the liquidity sweep, and then at this candle right here, price went back into the range, which tells us that, okay, this is a high probability liquidity sweep. Price started to go up. There is a reaction here that induced people who are not looking at the higher time frame, or not even looking at this liquidity sweep right here, to enter short, which is totally wrong because we already took a liquidity level here. So a lot of people are induced here, especially people who are taking lower time frame entry. They'll be stopped out by this candle. And what do we see here from this candle? This candle actually closes above the fair value gap. Closes above the fair value gap, which means this fair value gap is now violated, and it's gonna be an inverse fair value gap. So instead of being a bearish fair value gap to take the price lower. However, because of this liquidity sweep, this is now an inverse fair value gap and is going to be bullish now. Same logic as the breaker. We have an order block. It's a bullish order block. However, when it's violated, then it's going to be a bearish breaker block. So it does the opposite. In this case, exactly the same. When I see this candle closes above, then I'm going to have a limit order at the beginning of the fair value gap, and I'm going to have a stop loss slightly below the inverse fair value gap. A lot of time I'll do, manual stop loss with a closure below the inverse fair value gap. But there are also times where I would not be in front of the screen, so I would have, a risky stop loss slightly below. Because if price comes back below the inverse fair value gap, then it's not valid no more. So in this case, price comes back into the beginning of the fair value gap, and then started to go up all the way to this draw on liquidity or liquidity level here. You could have taken some partials here, and then your final take profit at here, but then price keeps going up more and more. However, this is a 5-to-1. Price did not go to the 50% of the fair value gap. That's why I always say by doing this, you are missing list trades. However, if you entered from the 50% of the fair value gap and price went there, you would get something like, maybe 6.5-to-1. So it's a higher reward to risk. However, you're going to miss some trades. And this example, so the same way we went over this, okay, this was a 30-minute. This was a 30-minute. This was a direct entry from the beginning of a fair value gap on the same time frame. This was on the 30-minute. We had the inverse fair value gap on the 30-minute, and we entered on the 30-minute. The same example here, I'm going to use a lower time frame entry entering this. And if I go here, this is the lower time frame entry approach here. So here was the sweep. The sweep happened here. This is the 3 minutes. The sweep was here. Price went back, and then after the inverse fair value gap being violated right here, and especially on the 30 minutes, we want to make sure it closes above on the 30 minutes. Then we're going to go to the lower time frame. Whenever price goes back into the lower time frame, we're going to look for any type of entry, whatever you prefer. You want to apply the 2022 mentorship model, or basically the first time you have an fair value gap, you can enter from it, or you can use the OTE. So in this example right here, we had no fair value gaps here. What happened is that price goes up, give us a break of structure, and this was our last leg. So if I take Fibonacci from here to here, we did have price coming back to the 62. That's where you enter, and you see price come back to the 62 with a stop loss below the 1, or basically below this low right here, and then we can target the -1. Or you can go back to the 30 minutes and look for liquidity levels. So in this case, this is a 4-to-1, a confirmation entry. Price comes back to the 62. You could have, have a buy limit here, and then target the -1, and you're gonna get there. However, you can apply any lower time frame entry, as I said, any lower time frame entry, whatever you prefer. Just make sure that you're having the inverse fair value gap as a confluence here, and it works very, very nice. Now, this example, it's a sell example, okay? It's a bearish example, and we're gonna go 50% of a fair value gap in this example. So this is GU, price take the buy side liquidity, and then 2 candles, and then get back into the range. So that's a very valid liquidity sweep. You see price immediately coming back into the range. This is 5 minutes. What do we see here? We see that this candle was disrespected in this candle right here. It was violated by this candle. It closes below, so as soon as it closes below, you can have a sell limit at the 50% of the fair value gap, and a stop loss somewhere above the inverse fair value gap. So in this case, you could have it above this high of a candle, for example, or you can just go closure above the inverse fair value gap if you're in front of the screen. In this case, price came back into the 50% and slightly above, and then immediately goes lower to this liquidity level right here. It takes this liquidity level and then started to go up. This is a 5-to-1 trade. Impressive trade. Now, the last example we have is a balanced price range, or basically a fair value gap inside of the inverse fair value gap. So in this example, what do we have? We're looking for this low which was taken by this leg from here to here. Price goes lower, and then one, two, and two candles below the level of liquidity, and then price immediately goes up above the liquidity, back into the range. In this case, this was our fair value gap, single fair value gap. Now we're looking at this leg right here. Okay, we're gonna ignore this fair value gap because it was actually filled, and then we're focusing more on this leg right here. Now what happens here? This fair value gap, price came here, and you can see there was a small retracement, which means some people were trapped here, some people were induced. Okay, some people lost, and then price goes up and closed above. So when you see this type of candle, you're expecting price to retraces back into the fair value gap, the inverse fair value gap. And in this case, what do we have? So we have no fair value gap here. However, we have a fair value gap here inside of the inverse fair value gap. So we have a balanced price range. In this case, we can enter from the inverse fair value gap, which tells us that, okay, this is a high probability entry right here. And this example, or this type of entry has a higher win rate. So in this example, price is back into the balanced price range, and you can enter from the 50% of the balanced price range, or go, beginning of the balanced price range. And you see, after that price goes up, takes this liquidity level, which you could exit at, or this fair value gap right here, where price reaches the 50% of the fair value gap. I would really recommend, when you see this type of entry right here, inverse fair value gap, and inside of it there was a balanced price range or fair value gap, this is a very high probability setup and a very high win rate. Okay, this is a game changing, and we're gonna put it under the test, and you'll see how it goes. So really focus on this, study this, and apply it, and you'll see how it works. Now, we did not cover a lot of examples, and there was only one reason, because I'm planning to do a full backtesting video about this. It's gonna be over a month or 2 months in a random date, and we're gonna go and backtest this, and we're gonna see how it's doing. Okay, so over 2 months or over 1 month, we're gonna see what are the results that we're getting. Okay, is it good, is it bad, or do we need something to improve? So wait for the next video. Stay tuned, as I'll put this strategy under the test, as well as other strategies. So make sure to check on my other videos. So as I said at the beginning, if you really want to use this strategy, separately, you can. If you want to use it as a complement to your current strategy, you can also do that, whatever you prefer. This was the end of the video. If you guys like to support me, then make sure to hit the like button, subscribe to the channel, and share this video with your friends. Make sure to join the Discord, as we do live trading. We send some PDF and some educational documents. This is Mulhan Trading, and I'll see you in the next video.